right, let's look at the last couple of problems. And this is an interesting problem because in this problem, here's the information. And what we want to do is we want to take these accounts and close them out. In accounting words, that means we need to zero them out. So why do we zero out these accounts? Well, you zero out your income statement accounts because those accounts need to be reset. That's the way I like to explain it. Every month you start out, your revenue has to start out from zero because you don't want your previous month's revenue to bleed into your current month. You want to know what your January revenue is. You don't want to know what your January revenue is if you had some of your previous months included with that. So every month you want to start over calculating your profitability, or I say every month, every period that you work on. So if you're working on a yearly basis, you want your 2023, 2024, 2025, whatever year you're working on, you want that profit to just be from that year. If you're just working on January, you want that profit to be from that month. And so every time you do the start a new period, you want to reset your income statement. You don't reset your balance sheet because those amounts stay with you. So you don't zero out your cash every month. You don't zero out your equipment every period that you do. But you do have to do that for your income statement. That's called closing. So what do you have to do? Well, we need to take these accounts and zero them out. So let's start with the sales revenue, right? So we're going to take the sales revenue, which is $350,000, and remember, sales revenue is a credit, and so to zero it out, we need to debit it. And then we're going to put it in a temporary holding bucket called the income summary. So our income summary, let's just zero this out. The income summary is a temporary bucket. That means it's zero. So we're going to put the 350 there. So we're going to see that in the... All right, so we're going to temporarily put it there. All right, then we get to all these expenses. The cost of goods sold is an expense, delivery expense, insurance expense. Those are all debit balances, and so we want to credit them all. And then if you add them all up, that gives you $329,000. So put the number in the income summary that would zero all of that out. So 329. And so this journal entry does that. And so that leaves us with a balance of $21,000. Now the income summary is a temporary place. And so what we need to do is we need to zero the income summary out and dump the income summary bucket into retained earnings. And so your retained earnings, we don't know what it is because they didn't tell us that. We want to zero it out. So if our income summary has a credit balance like we do here, because the credits are bigger than debits, we're going to need to do a debit balance in order to get it to be zero. And so we're debit the 21,000, and then we're going to put that into retained earnings. We dump the income summary temporary bucket into the retained earnings temporary bucket. And so when this is all said and done, now all your expenses are zero, all your revenues are zero, and everything's been poured into your retained earnings, and you're ready for the next month. That's what they mean by closing. Now, of course, this is all done automatically now through the software, but we need to understand as accountants what's going on behind the scenes so that we understand how to utilize the system as an accountant. All right, that's exercise 2-14. Let's look at the next exercise, 2. All right, so here's what we have. We have this kind of funny looking, I don't know, I guess chart here. And it shows you the sales. So all of our 2024 sales, right? So these are the sales for 2024. However, the cash from the sales weren't received in 2024. Some of the cash was received in 2025. Some of the cash was received in 2026. All right, we have expenses. These are 2024 expenses, but some were paid in 2024, some were paid in 2025, some were paid in 2026, and on for the other 2 years. All they want to do is create the cash basis versus the accrual basis. So how does that work? Well, to make it simple, cash basis means that your revenue is counted when you get the money. Now this doesn't make much sense to accountants, because the revenue should be revenue when you earned it, not when you received the money. So if you did a job, that's revenue, whether or not they paid you or not. But the cash basis doesn't care. The cash basis is sometimes people call it a simpler way of doing it, but it's simpler, but you give up the ability of understanding your true organization. What's going on? How much profit did you get? We don't know the profit, we just know the cash. So there's a lot more to talk about, but this is just a starting point. So here's basically the way this works. So for the cash, to do this problem, for the cash basis for 2024 and 2025, go vertically. So for 2024, take all the revenue by going up and down for, so that's $295,000. Take all your expenses going vertically. So the 185 and the 40,000, it's going to give you 225, and that's how you do the income for the cash basis using this situation. The same for 2025. You take the revenue going vertically, add those two up, take the expenses, add those two up, add those three up, and we get 272, and we get the profit. Now, to do the accrual basis, go horizontally. So take all the sales, whether or not you receive the cash that year or not, so 295, 160, 30,000, add those up, and that gives you the revenue for 2024. For 2025, you go vertically, you do 0 plus 355 plus 90, that gives you 445. Then the expenses go horizontally, 185, 67, 25, that gives you 277, 40, 160, 55, that gives you 255, and so then you can get your profitability. The difference between the cash basis and the accrual basis is timing, when you acknowledge the revenue and when you acknowledge the expenses. But timing is very important. As you can see, 2024 under the cash basis, your profit is 70,000, but under the accrual basis is 208. It's 243,000 versus 190. So the profitability is much different. Ultimately, it will be the same. It's just a timing situation. But if you look at year to year, you're not getting the same profitability year to year because of the timing of when you recognize the revenue expenses. This is a really important concept, and we're going to talk about this in a lot more detail. But just remember this. We like accrual basis because it puts revenues and expenses in the periods in which they were earned or incurred, not caring about when the cash came. The cash basis doesn't care about that. It just cares about when the money was received in your pocket or paid out of your pocket. The cash basis might seem simpler, but what you get is a misunderstanding of the true profitability of the organization. We'll see this in more and more detail as we go through this. So that's how you do those two problems.